What if I told you there's a way to invest in hundreds of companies with just $20 and almost zero effort? I'm the Wealth Wizard, and today we're breaking down index funds in the simplest way possible in 4 minutes. And by the end of this video, you'll understand exactly why Warren Buffett calls them the best investment for most people. Let's start with a story. Imagine you're at a giant buffet with hundreds of different dishes. Now, you don't know exactly which ones you'll like or which ones might taste bad. Instead of filling your plate with just one risky dish, what if you could take a spoonful of everything? That's essentially what an index fund does with stocks. An index fund is like a buffet plate that automatically gives you a little portion of many different companies all at once. Instead of betting on just one stock, you're holding a small piece of hundreds, even thousands of them. Some will be winners, some might be losers, but the overall plate averages out, giving you variety, balance, and way less risk. Here's where it gets interesting. Instead of trying to pick winning companies yourself, which is incredibly difficult even for professionals, an index fund simply copies a list of companies. The most popular list is the S&P 500, which includes the 500 largest companies in America like Apple, Microsoft, and Amazon. But why does this matter? Let's talk about 3 massive benefits. First, instant diversification. If one company in your fund crashes, you still own pieces of hundreds of others. It's like having backup plans for your backup plans. Second, incredibly low fees. Since no one is actively picking stocks, these funds charge minimal fees, often less than 1% annually. Third, consistent long-term growth. Over the past 50 years, the S&P 500 has averaged about 10% returns annually. Now here's the part that blows most people's minds. You don't need thousands of dollars to start. Many index funds let you begin investing with as little as $1. You can set up automatic investments of $20 or $50 monthly, and the fund handles everything else. Even investing as little as $500 a month for 35 years would total to $1.7 million. That's enough for spending over $5,000 a month in retirement. Let's address the biggest concern beginners have. What if the market crashes? Here's the reality. Markets do go up and down short term, but historically, they've always recovered and reached new highs over time. Index funds are designed for long-term investing, not quick overnight profits. Getting started is surprisingly simple. Open an account with any major brokerage like Vanguard, Fidelity, or Schwab. Look for funds with low expense ratios, typically under 0.2%. Popular options include total stock market funds or S&P 500 funds. The beautiful thing about index funds is their simplicity. You're not trying to beat the market, you're joining it. You're buying a piece of the entire economy's growth over time. Remember, this isn't financial advice, just education. But if you're ready to get started with index funds, then check out this video on screen right now, which will show you exactly what to do now with this information. Remember, this information can be the difference between retiring rich or retiring with nothing.